George Schultze, Puerto Rico has pulled its $750 million sewer bond offering, not because of choppy equity markets, because the yield was just too high. So what does this mean for currently outstanding Puerto Rico bonds?
I think there's trouble, more trouble coming in Puerto Rico. The whole island is distressed. One of the reasons they pulled the offering is because the investors didn't like the idea that the company, or the island at the same time, was asking the U.S. Supreme Court to approve a new bankruptcy law for them to restructure their debt. So the problem is Puerto Rico, with about $72 billion in debt, it really has to restructure its debt, and that's why the bonds couldn't be sold.
And how do you think this is going to play out? Like Detroit? Because Detroit went bankrupt. They recently came back and sold a $250 million offering, I think, in the past 2 weeks.
It won't be so clean, and Detroit wasn't that clean. The debt situation in Puerto Rico is about 10 times larger in terms of municipal debt, and Detroit, when it went into trouble and had bankruptcy, that was the largest municipal bankruptcy ever. So Puerto Rico is much larger, and the fact that they can't benefit from Chapter 9 laws to restructure their debt just makes it much more complex. So they'll have to restructure debt on an issuer-by-issuer basis. Pretty messy without a guideline and a template law to govern the whole thing.
So as a distressed bond or a distressed security investor, are you getting involved in Puerto Rico munis at all?
We are not. In our view, the best opportunity in Puerto Rico right now is buying distressed real estate. There are a lot of auctions, there are a lot of liquidation sales, there are heavily discounted properties available for sale that are pretty interesting there. So we're looking at buying properties, commercial office space, at well below replacement value and replacement cost.
Let's switch from munis to high yield. The high yield market really hasn't gotten hit as hard as the equity market. It's down a little bit, but certainly not as much as we've seen in equities. Back in the winter of 2014, a lot of energy companies really dragged down the high yield market. So what's your view of high yield right now?
It's not done yet with energy. Energy is about 20% of the high yield market, and it's just getting worse. Right now, oil prices are just under $40 a barrel, down from over $100 last year, and the situation for these energy companies is getting worse and worse. Cash flow is declining. Most of them have not been able to successfully reduce debt. You've seen a number of bankruptcies already, and there's a big one coming in a couple of weeks. Samson Resources is about to file for bankruptcy. That'll be the largest energy bankruptcy ever. And we expect that by the middle of September.
So would you advise investors sell their high yield funds right now, or if high yield fund has a large exposure to energy still, get out of it?
I think that is the right course. I think the best trade, though, if you're looking to make a trade, is to short sell companies in the energy space that have a reasonable prospect of heading into bankruptcy. And there's a growing number of those. There's a list of about 20 that we've identified that look like they have either they're just deteriorating credits or they're on the verge of bankruptcy.
All right. Well, thanks a lot for coming on and talking about some distressed opportunities, George.
My pleasure.
Thank you for watching The Street.